This minimum tax would make sure that the wealthiest Americans no longer pay a tax rate lower than teachers and firefighters. This was recently mentioned in a White House press release earlier yesterday morning. Hello my friends, this is Ruben, and in today's video I'm going to talk about Biden's Billionaire Minimum Tax, also known as Biden's Billionaire Tax. I'm going to go into detail about what this tax proposal is, how it differs from current tax law, why Biden is proposing this, who does it affect, whether it is fair, and whether it will become enacted. Now stick around to the end of the video to figure out what Elon Musk and Jeff Bezos are going to have to pay if this law gets enacted. Before we get into the topic, please click that like button and subscribe if you haven't already. It helps out tremendously. Per the recent White House press release, the Billionaire Minimum Income Tax will ensure that the very wealthiest Americans pay a tax rate of at least 20% on their full income. Specifically, it calls for those who are worth more than $100 million to pay at least 20% in income taxes. Now, it considers full income to include traditional forms of wage income, such as a W-2, but it also considers full income to include things such as money that you may have made in unrealized gains. The best way to explain the new tax proposal is through a stock market example. Now let's say you're in the market and you're buying Tesla shares at $1,000 a piece. You purchase 10 Tesla shares at $1,000 a piece, so that's $10,000. Now, over the next few months, the Tesla stock price rises to about $2,500. Well, your shares are now worth 10 shares times $2,500 a piece, or $25,000. You now have an unrealized gain of $15,000. A gain is the difference between what you paid for and what it is currently worth right now. Now, it's currently unrealized because you haven't done anything with it. You haven't sold the stock. You don't really get the money for it until you sell it. And the moment you sell it is the moment it becomes a realized gain. Now let's say when the stock hits $2,500, you do sell. Well, now you have a realized gain of $15,000. Currently, there are no taxes for unrealized gains. This means that someone only pays taxes for when they sold something, not before it. Now, currently, there are two types of gains. There are short-term capital gains and long-term capital gains. Now, short-term capital gains are profits that you make from selling an asset that you've held on to for less than 1 year. Long-term capital gains are profits that you've made from selling an asset that you've held on for more than 1 year. Now, short-term capital gains, they're taxed at the ordinary income tax rate, basically the same tax rate that you have for your W-2 income. Whereas long-term capital gains, they're actually taxed at either 0%, 15%, or 20%, depending on your income tax bracket. There are also carve-out rules and like special tax rules for things such as real estate, gems, stamps, collectible items, art, even wine and brandy. Our tax system has a whole bunch of weird complex stuff that has loopholes for things that really the average American never deals with. And that's a problem. The purpose of this new tax, per the report, is that the new minimum income tax will eliminate the ability for unrealized income of ultra-high net worth individuals to go untaxed for decades or even generations. Per the report, the proposed tax levy will reduce the government's deficit by $360 billion in the next 10 years, or $36 billion per year. It's important to note here that deficit and debt are not the same thing. So the new tax doesn't automatically reduce the government's debt. In fact, it just means that they gain about $36 billion a year in additional revenue. Now, whether or not that money is actually used to pay down the debt, we'll have to see that in the newly proposed budget. Now, according to an analysis referenced in the press briefing, the White House indicates that billionaires on average pay only 8.2% in federal income tax. Now, here's another thing though. They're talking about federal income tax in their definition of what an income is, so they're including unrealized gains. Now, currently, unrealized gains is not taxable. Now, in the same analysis, it indicates if you take away unrealized taxable income, the average individual who earns more than $1 million pays approximately 26% in federal income tax. Therefore, the analysis is more based on wealth and not income, so some could consider this to be a wealth tax and not an income tax. Nonetheless, this tax would actually affect only about 700 individuals in America. If those individuals are already paying 20% towards taxes of what the government would consider full income, that means ordinary income and unrealized gains, then they're okay. However, if they pay less than 20% income tax total, they have to do something called the top-up payment to meet the new minimum. Here's the funny part, in my opinion, about all this. According to the proposal, they have the ability to spread out this payment over the next 9 years. And then any subsequent payments, they can spread it out over 5 years. Now, this means that a lot can happen during that time. It also states that e-liquid tax taxpayers can actually delay payment and then just pay interest on the balance owed. Now, it doesn't state what the interest rate would be or what the government would consider at the time illiquid. It could be stocks, it could be real estate, it could be anything. Being fair with taxes is a tough subject and it is difficult to determine because fairness could be defined as whether it is in accordance with rules and standards or whether it is just, as in morally upright and good. Now, let's take the first definition of being in accordance with rules and standards. We could therefore theoretically argue that any law is fair because it is in accordance with rules and standards. However, I think we can all agree that there are a lot of laws that are not just or morally right. So let's scrap that first definition and let's go with, is it morally upright? Is it good? Is it a just law? Now, is it a just law though? There's a large consensus that ultra high net worth individuals should have an increase in tax rate. However, that was under the current definition of what income truly is. Therefore, it could be really said that this law is not about increasing the income tax that ultra high net worth individuals pay, but more so about what income actually means to the government. Now, should we actually call unrealized gains income? What happens if it goes down? What happens if your unrealized gain becomes an unrealized loss? Now, currently there are provisions in the tax code for realized losses. Should we or could we even change the tax law to also include unrealized losses? Would that be fair? Would that be morally just, upright, and good? My own opinion is that unrealized gains and losses should not be considered taxable event. The precedent that this sets, I think, is too steep compared to the gain that we get. That is pretty much just a rounding error for the US government. Think about it, $36 billion per year. That's 0.6% of the newly $5.7 trillion proposed budget. Now, what it does do is set the standard for Americans to get even taxed more through a newly defined income of unrealized gains. Now, you may consider that might be just a bit of a hocus pocus, but the reality is that the federal income tax at one point was supposed to be temporary and was really only targeted toward those really wealthy Americans. And now a lot of the middle class also pays federal income taxes. It would not be surprising to see that this tax policy gets broadened out over time, so that those individuals in the middle or middle high income tax bracket actually have to pay more in income taxes as well. Currently, the Constitution requires that federal direct taxes are apportioned among the states. Direct taxes are taxes levied on people paying them rather than goods and services. This means that each state must pay the same amount of tax on a per person basis. This would most likely be the defense for anyone who's against this wealth tax. The 16th Amendment to the Constitution, ratified in 1913, created an exception to this, allowing the imposition of federal income taxes without apportionment. It states, "The Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states and without regard to any census or enumeration." As I mentioned previously, Congress could change the definition of what income truly is, and it does state income from whatever source derived. That could be really a good, compelling argument for this income tax. Let's get to the fun part and see what the two wealthiest Americans would have to pay for in income tax if this actually went through. According to economist Gabriel Zuckman at the University of California, Berkeley, Elon Musk would have to pay $50 billion and Jeff Bezos would have to pay $35 billion in additional income tax for this law. Now remember though, here's a crazy loophole. They would have to pay this over the next 9 years, or they could delay it and pay interest, of which we certainly don't know yet what rate that would be. The question once again is not whether or not we should tax the rich more. In fact, the question is, what is considered income? Should unrealized gains be considered income? I know this does not affect the majority of Americans. In fact, this tax law would not affect 99.9999% of Americans. But is it okay? Is it just? Is it morally right? Is it good? What do you think? Comment below on whether you think we should consider unrealized gains as taxable income. If you've enjoyed this video, please click that like button and subscribe. It helps out tremendously. Thanks for watching. Share with your bros, baes, and buddies, and I'll see you tomorrow.